Joseph, like a lot of people, I had a horribly traumatic morning with the bond market yesterday, and I'm still nursing my emotional wounds, but maybe we can start the healing process here today. What happened yesterday?
Well, you're not going to start the healing process with banks. So, I mean, what happened in the US Treasury market, which is one of the biggest and most liquid markets in the world, almost $1 trillion worth of treasuries were traded yesterday, according to ICAP data. What happened in terms of yields was, well, these moved 30 basis points down in minutes in the US morning, which is like that sort of intraday move hasn't happened since the Lehman crisis.
So, do we have an explanation, or is this?
Well, just... as I mentioned banks at the beginning, banks have for the last few years loved to complain that regulation is forcing them not to hold inventory of any kind of bond.
Tradable inventory.
Yes, yeah. And one of the issues,
they have to hold a lot of treasuries. They just can't trade them around. Is the issue here, right? Or maybe I misunderstand.
Well, no. Well, yes. I mean, when it comes to liquidity rules, so regulators want banks to hold assets they can sell quickly in a crisis. Treasuries fit that bill, and so fine, hold hundreds of billions more treasuries on bank balance sheets, but that means they can't trade them.
Right.
Really, because they'll need them for a crisis to sell.
So is Lex here saying that the whinging banker who says that all bad things are done by prudential banking regulation is in fact correct in this case?
Well, no, there is an element of special pleading. But they were the complaints were really about sort of liquidity in the corporate bond market, where dealer inventories have really sort of plummeted since Dodd-Frank and the Volcker rule in particular came in.
Sure.
So you can't trade this stuff anymore. But this is treasuries. This is different. And also it's the Fed is the closest it's come to sort of tightening in the last 5 years. And so on.
So there's other factors.
There will be, and if it can happen to treasuries.
Right, that's the next question. So if this happens in the most liquid market in the world, what is the next market we are looking for? Something that makes this look like crumpets and jam, as it were.
I think you have to understand that bond markets are very different to equity markets because there are lots of different kinds of bond. And whereas, equities, they kind of behave quite similarly. Not the case in MBS, CMBS, leveraged loans, etc. And so when you look at the Greek bond market, for example, which has been this very well performing asset in the last year or so, and yet today trading fell apart. And by falling apart, I mean the difference between the sort of the bid yield and the ask yield for Greek bonds blew out quite considerably. As in, so there's actually very little trading going on. And this, comes to the point about, well, why should we care really? Is, well, look, when the banks aren't sort of warehousing this stuff, what you get is much more buy and hold activity by investors.
And the summary is, if you think this was scary in the treasury market, participants in smaller, less liquid markets are in position for a real scale.
There's going to be a repricing of risk,
Thanks very much, Joseph.